And there's a big emotional shift for sellers because, all diligence efforts are challenging because there's requests from a buyer for things that you may not have looked at in some time. And your ability to be prepared and to be able to answer confidently and to hopefully have worked with a good advisor helping you come to market and doing pre-diligence work has been put in place to minimize your distraction as you continue to run the business moving forward. Hello, and welcome to this week's Shoot the Moon podcast, broadcasting live and direct from Revenue Rocket World Headquarters in Bloomington, Minnesota. We are the world's premier M&A advisor to tech-enabled services companies. With me today are my partners, Ryan Barnett and Matt Lockhart, as we continue our work through our Masterclass. Ryan?
How's it going? And hey, Matt, thanks for joining us here today as well.
Of course. Great to be here. I know we got another interesting topic in our series that, we're getting a lot of good feedback on this Masterclass on, how to maximize the value of your business when you're ready for a transaction. So let's keep it going.
Yeah, and thanks for setting that up, Matt and Mike. Heretofore, what we've talked about is getting through that decision of knowing when to sell, getting your house in order, understanding what your firm is worth, kind of what you're going to take home. We transition that into the process, so working with your team, kind of what month one looks like, how you find buyers, and what goes on in indications of interest, and getting an LOI. And then last time we covered deal structures and things like earnouts and selling notes. So today, if we follow that logical progression and you think from the start of a process to where we're at now, the deal terms have been struck in an LOI. And what happens after that, in nearly every case, at least that I've seen, is that we move into a due diligence process. And Mike, I will just get us started with an easy question here, but what is due diligence and what does it mean for buyers and sellers when we get to this point, and just help define due diligence to start?
Yeah, you bet, Ryan. So due diligence is really the buyer initiating an inspection of your business, if you're the seller, to confirm what you're saying about your business is actually correct. And what you're saying as it relates to your financial data, your legal data, as it relates to your contracts, et cetera, so that they understand that what they're buying, any assumptions they made in analyzing your business in preparation for the LOI are in fact proving out to be the case. And so, what happens is the buyer sort of shifts from the excitement to, hey, this 1 + 1 really equals 3 or 4, to risk mitigation, right? Diligence is designed to surface risk and in some ways price it in if there's things that were unforeseen in there that are discovered in their analysis. So the volume of review and questions about the business and requests about the business and its documentation, particularly financial and legal, turns to much like an audit of the business. And there's a big emotional shift for sellers because, all diligence efforts are challenging because there's requests from a buyer for things that you may not have looked at in some time. And your ability to be prepared and to be able to answer confidently and to hopefully have worked with a good advisor helping you come to market and doing pre-diligence work has been put in place to minimize your distraction as you continue to run the business moving forward.
Yeah, Mike, that's a great setup. We do both buy-side work and sell-side work here, and we're versed in understanding what that diligence request can look like, as well as helping people defend those requests. And I tell you, when we coach people from day one, that first request is pretty daunting. And so it looks like a lot. And in reality, when you're going to market and going through a process and you have an advisor by your side, this process can be a little less daunting. if you're tackling it, but it does feel like a lot. Matt, if we think about this in like real world practice, and you think about tech services firms and MSPs, CSPs, and app development firms, what's the biggest mistake sometimes these firms have when they're starting that diligence process?
Yeah, I think Mike touched on the emotional aspect of it. It's high emotion to enter any process that you are looking at to transact your firm. And then, you get to that LOI stage and you feel like, hey, somebody is really interested in this business. This is done, right? And they minimize the due diligence process. They minimize the risk that occurs in the due diligence process. And quite honestly, oftentimes, if they are not working, with a good advisor, they are unprepared for the due diligence process. So, the biggest mistake is both emotional, right, in the context of thinking, once a letter of intent is signed, this is going to be easy, and then practical in that they simply are not prepared for the audit and inspection, that is forthcoming. So, and this isn't the case with, any of our clients, but I was reading an article just last night about Uncle Nearest whiskey. And this is the hottest whiskey on the market 3 years ago. The founder, valued the business at $1 billion. Well, after inspection, it looks like they're about a break-even company, if not less. So you got to kind of make sure that you put yourself in the eyes of a buyer who needs to ensure that what they have been promised is true. And the more organized and practical that you can make that due diligence process without emotion, really the better.
That's such a great point. What a buyer's trying to do here is validate, and the seller's trying to kind of prove. And sometimes that leads to a mismatch in what's being acquired. Mike, I guess the question here jumps a little bit off of what we were talking about earlier, but how do buyers end up using the results of due diligence then? In the case that I heard with Matt, I heard perhaps different deal terms. But what else do buyers utilize the results for?
Well, it certainly could mean different deal terms, but it also, emphasizes where a buyer may need to invest in the business to further grow it or to further realize their return. For example, there may be an opportunity to invest in further sales and marketing resources to, accelerate growth, or there may be an opportunity to get consolidation savings with an existing operation, particularly if the buyer is either a strategic buyer running a similar business, albeit larger, or someone who has outside capital in a strategic business where there can be some savings, when they combine the businesses. And those synergies or those savings usually go to the buyer, right? So validating where there's opportunities for not only maybe chinks in the armor in your own business, but also where there's synergy opportunities, and discussing those synergies, with you ahead of time, are all things that impact their return rate, right? And they're going to want to make sure that they have clarity around all of those things to make sure that they can get the highest return for their investment. So when you think about risk, yes, risk is certainly a component of mitigating risk and understanding risk, but also the upside potential of the combination is something that, people certainly focus on in diligence.
Yes, and even some of the outputs on that might be extreme clarity around an earnout. So last week we talked about deal structure. And part of the letter of intent is going to be perhaps high level on an earnout. You have to hit XYZ revenue in XYZ time to get XYZ result. And so due diligence also can have some results. To your point, if you have the opportunity to capture upside, that can happen. You can also have business improvement during that time. If you're an extreme growth business, this can be a great time for a buyer or for a seller to really perform well, to the point where you have to take another look at what that deal looks like. If we're in this process and we're aiding sellers, Matt, what's the role of an advisor during that? Where do either us or someone else, how does an M&A advisor come into play during this part of the process?
Yeah, I mean, if it's probably a good debate class on what is more important in the role of an advisor, to get to a letter of intent with the right party, or to successfully move through the diligence process to close, with the right party. So a good advisor is really side by side and taking on the role of first point of contact for all diligence related items. As you know, it's sort of the old Mary Poppins saying, well begun is half done. A good advisor is going to ensure the cleanliness of all the data, that it is in line with the story that's been told towards the letter of intent. There's cleanliness in terms of the chart of accounts, obviously the P&L and the balance sheet, and et cetera, et cetera. So the advisor is going to make sure that going into the due diligence process, everything is well understood. It is absolutely defensible against the expectations of a buyer. And then, obviously there's need for clarification throughout the due diligence process. And the advisor is ensuring that there is a very quick response. Now, in addition to that, as we've talked about in the past, there's always nefarious actors in the marketplace who are attempting to, have a history of bait and switching or retrading. And they work towards getting somebody under letter of intent, with the knowledge that they're going to try to reduce the purchase price, come hell or high water. And part of the advisor's job is to ensure and understand where there's indicators that could impact the eventual transaction price. So the advisor is absolutely critical, should be very forward in the process, should be very well organized, and, ready to get your elbows up if need be during the due diligence process.
It's really well said. I think that what we lead from due diligence, and part of what's in our next podcast we'll be covering too, is the crafting of those definitive agreements. To your point, these coincide together and can flow from one kind of process to the next. It's having a continuity throughout starts to become critical for the success of a deal. Mike, I'm going to go back to a little topic here, and you covered this a bit, and I just wanted to make sure that we're addressing this, or the sellers really understand kind of what firms are looking for. So, it seems like the list always explodes. Like, we start out small, and then we dig up, we find a little bit more, and then we find a little bit more. And then there's just a lot of different areas of focus that are going into this. And I was hoping you can cover, what are top diligence areas that many buyers are focusing on, and then B, how does an advisor help triage those requests and and perhaps even pushing back on requests that are not really meaningful for the deal to get closed?
It's really interesting. It's a great question, Ryan. And I would tell you that, usually most of the broad categories are around sort of revenue quality, customer concentration, contracts and renewals, security posture, key person risk, scalable delivery model, among a variety of other things. But what's important to note is that there can be great scope creep in diligence just by the number of actors that are involved. So, for example, usually, and we do this for our buy-side clients, we manage, collate, and analyze diligence information alongside them and on their behalf. So we kind of know how to run these processes, whether you're selling or buying. But oftentimes when a buyer, particularly a funded buyer or a private equity buyer, needs a quality of earnings analysis and they bring in an outside audit firm to help them, they'll ask all the same questions without sort of fully understanding what's already been covered by the buyer. And that's not atypical, right? Where we'll, populate a data room, we'll put everything that the buyer's requested in there. And it's not atypical for other parties to come in, whether it's a tax advisor or a legal advisor, maybe someone doing a quality of earnings analysis, to ask the same questions over and over. So oftentimes it can feel a lot like Groundhog Day. It can feel like, well, yeah, we answered that question 5 times already, and the data's in the data room, and if you'd go look at the data room, you'd have it. But the new folks that are coming to the process as it continues to grow and mature don't have the legacy context for what's in or what's out, and may not have been shown the data room in a meaningful way. So there's a lot of asking the same question over and over by different parties. And sometimes the questions get answered, slightly differently, or even the same questions by the same parties, because they either forgot or they didn't know they analyzed it previously, or there was time that went on where they need to refresh the data throughout the diligence process. They need to look at a fresher set of financial data or customer data or whatever. And that can be, super frustrating, right? And an advisor that knows their way around does what we call diligence defense, and they can guide the buyers in a fairly unemotional way as to where is the data, and it minimizes the distraction for you, right? That's a huge benefit that advisors bring to the party. And so, when you think about who all has to sign off on a diligence effort, you've got a variety of actors from the business that's doing the acquisition, maybe their financial sponsor, someone looking to do a full quality of earnings analysis, a tax advisor, a legal advisor, and there may be even other strategy advisors that are trying to get their arms around, integration teams, and they're all looking at similar sets of data and probably have similar sets of questions. And so being able to be well organized, on your game, and working with an advisor that can help, remove the redundancy so you're not just distracted by it or feeling like it's a, 1,000 cuts, is super helpful.
Yeah, absolutely. I think you nailed that well. And if I think about this as well, Matt, when we think about some of the areas that people are digging into, and as Mike was mentioning, that where you need defense, what are a few things that CEOs or owners should understand, kind of red flags that you should be aware of that could lead to a retrade or a restructuring of an LOI that might come up during due diligence?
Yeah, I mean, a couple of different things, I think. First off, and we can't say this enough, that and any good advisor is going to ensure that this is the case, is that the business needs to be humming along, right? It needs to be on an upward trajectory, needs to be sort of meeting general forecast, et cetera, et cetera. So That's critical. But as it pertains to, sort of specific items beyond, the ongoing going concern of the business, things like the cleanliness of contracts, right? That is in place. Obviously, we talked on before the cleanliness of financials, that there are not outliers that are in place that can bring question to the overall data set. And then, sort of major changes in the business. You aren't going to all of a sudden shuttle a service line or something along those lines. The most important part in a diligence effort is, again, I go back to this aspect of practicality. It's just the facts, ma'am. And the more that you can have preparation of the data and the things that I just talked about, contract cleanliness, financial cleanliness, all of those things should be very well prepared and easily understood, so that there is not a quote unquote perceived risk in the business that is underlying, the data. So, again, it does also go back to understanding the buyer personas and ensuring that, what appears to be a good and willing buyer that lines up strategically, is indeed the case.
Yeah, great. This has been really great content, Mike and Matt, for understanding this process. Again, it can feel really daunting, but once you walk through it, the reward is great. And if you're running a well-run business and you have a lot of your documents in order, it's a process that can be relatively smooth, and you surround yourself with the right people. Mike and Matt, just kind of last closing thoughts, but if you could give one piece of advice to a CEO heading into due diligence, what would it be? Matt, why don't you get us going and pass it over to Mike to end?
Yeah, I think that this context of momentum, we believe we work in, the middle, the upper market space. Any well-executed due diligence process, should be done in 90 days. And keeping that momentum throughout the process is absolutely critical. If there's bobbles in the momentum that are not understood, well, then that's a red flag. And you need to address those red flags, right away and get those resolved. But keep that momentum, keep the promise of the future of the combined firm, and get to that finish line. Mike.
Yeah, I would add that this is it can be an exhausting phase of the M&A process. The M&A journey, it's been said many times. You've heard us say it many times. It's the most unnatural act in business. That will feel like that in spades at this phase, as you're going through a due diligence effort. And I think it's important to not let it become such a distraction that it negatively impacts the business. It's a big risk, and how you mitigate that risk is that you make sure you have a competent advisor that can help you navigate and defend your diligence, so that you're not spending every waking moment trying to continue to manage and run the business, as well as respond in a timely manner to the diligence requests. It's very, very challenging for an owner and a small leadership team to respond to all of the diligence requests in the time that a buyer would expect them while running the business, and have it not negatively impact the business. And the problem is, when it negatively impacts the business during due diligence, you're setting yourself up for a retrade, because the buyer will see softness in your business, And they will start to say, well, what's going on? And why is there softness? And we've seen 2 months of revenue going down, and, and they're going to retrade that deal. So it's a solid investment for you to have a great advisor that can, act on your behalf in diligence defense, and you can keep your eye mostly on the ball. There will be some distractions, right? Because there may be data that wasn't collected that was asked for, or a slice and dice of the data that comes later in the process. And so there's enough distractions as it relates to weighing in not only due diligence, but also into legal requests from your own team on definitive agreement fortification. So if you can offload some of that or outsource it to your advisor, I would encourage you to do so. And with that, we'll tie a ribbon on it for this week's Shoot the Moon podcast. Certainly appreciate you tuning in, and we'll keep moving through our masterclass on how to manage and prepare your business for sale in next week's podcast. And with that, make it a great week.